Good afternoon, everybody, and welcome to the October 10, 2018 Mastering the Bear Open Forum. This is your host, Josh. Unfortunately, today, of all days, a day like today in the market, our Chief Market Strategist, Dan Russo, is unable to be with us. He is at some what sound to be very cool and important meetings and conferences. So I'm happy he is there for Chaikin Analytics. Unfortunately, that means he can't be here with us today. Please, if you have any questions, the Zoom Q&A window, you can access it in the upper left-hand corner of your screen. Nothing I say should be taken as advice, and this is being recorded and will be available to you upon request. You can request a recording of this session by emailing us info@chaikinanalytics.com. That's info@chaikinanalytics.com. So, big down days in the market today. I am not a market technician like Dan is, so I am going to reference Dan's note from this morning first that he sent out to Chaikin Analytics subscribers. If you're not a Chaikin Analytics subscriber, these are some of the things that we send out in our Morning Insights note. And if you're a Chaikin Analytics member who's not reading the Morning Insights, you should. It's got some great information in there. But what we're looking at are two areas of support right off the bat. We tested one and effectively broke it, which is 2873. The next one, 2800. And that seems like a reasonable target at this point. So we closed on the lows today. It was not a good day for the bulls. It was kind of day that the bears have been looking for. We happen to close a number of positions this week as well. Let me see that in the note. So let's go through the note. Dan focuses, as we do here at Chaikin Analytics, at using a top-down approach. And what we look for are to hunt, when we're hunting bears, to hunt the weakest sectors and then the weakest industries inside of those sectors, and then the weakest stocks in those industries. And for a while, the consumer discretionary group had been outperforming the market on a relative basis, but had a weak power bar ratio, the number of bulls to bears in it. A lot of this is made up by Amazon, and under the hood, there's a number of industries inside consumer discretionary sector. Right? Sectors are made up of a number of industries that look like they were rotten, but the sector as a whole looked okay. Now, with some weakness coming into Amazon, the whole sector is looking pretty bad. So Dan went in and looked at one of the industries and picked out one of the stocks that he thinks is turning around. Bit of an turnaround play on Domino's. You can see that Domino's Pizza had been above a rising trend line for some time. It had acted a bit as support. At this point, it has really failed to stay above it now. The relative strength is waning to the point of non-existence. And the money flow on the move up, if you look down, you can see money flow has been negative. So on these moves higher, on these bounces, the money flow stayed poor, even as we went above the long-term trend line. So it's turned very bearish, relative strength waning in a terrible industry, now a poor sector. So Domino's was the pick of the week. All right. It has relatively high Financial metrics, you can find other stocks like Domino's by using our discovery tool. And comes up with quite a number of fast food and fast food-ish chains here. And you can go and look at those for also weakness. If you have any of these in a long-term portfolio, you can also see the swaps there available to you. So similar industry, but better performing stocks. So as I mentioned earlier, and as I showed the chart, the support has been broken. Now testing the key breakout level of 287. The market closed today below that level, I believe, which favors a move lower to 280. The large caps are continuing to outperform the small caps, which suggests that breadth is weak. And the SPY, it's oversold currently. Now, it could stay oversold for some time. And we could also have a series of down days while we're oversold, which could take us quite lower. But we are oversold. Money flows bearish. It's bearish on a move lower. We could see more weakness. The story for markets that has been in a lot of the headlines and we've been following is the move up in rates. Dan's been talking about how rates under 5%, when they're rising, but still under 5%, which we are now, we're in the threes, are not bearish for markets in and of themselves. Part of that is context, though. It's how fast they rise. Sharp moves tend to spook markets. We've had some sharp moves in the treasuries. Dan thinks it's going to go higher, that treasuries are going to continue to drift higher. If they do so orderly, we would expect it not to be necessarily bearish. If they do it disorderly and quickly, that would be. So we're going to keep watch on that. This is a chart of the consumer discretionary sector, which I mentioned earlier. You can see the relative strength has changed recently against the market. The money flow is registering its deepest of the year and uncharacteristic for a strong uptrend. You usually do not get really deep, prolonged readings like that when you are in a nice uptrend and outperforming. Then put another chart out here, which is the ETF PEJ, which is a consumer discretionary ETF. You can see that is one of the industries, so one of the areas inside of consumer discretionary. It's been underperforming since August, has risen twice on negative money flow. Both times to the long-term trend line on negative money flow. And failed. So this is another good bearish play, honestly, I think. If you get, I would wait for a bounce, but looks like another good bearish play. In the sectors, there are still a number of sectors that are doing really poorly. The materials, consumer discretionary, as we mentioned, with power bar that's very weak, now underperforming. The staples, real estate, technology has turned around. I think a lot of this is due to a lot of bulls becoming neutral rather than sort of an increase in the other way around. Although the bears have also ticked up, I believe. These are the sectors where we're going to go hunting. Maybe even XLK. XLK is outperforming still. But the ones with weak power bar ratios and negative relative strength, that's where we want to go hunting for our bearish stocks. Dan put together a bearish put spread. Is put spread which maximizes if you get down to 260 by November 16th. Breaks even at 279.60. Almost a doubling of your risk versus your reward. I think that POP is very good. And finally, as I mentioned earlier, we closed a couple of positions, Win and Alcoa, the stock and options positions that we had in those. We closed out yesterday on more down days for them, I believe, which were some impressive picks. So congrats to anybody that went along for the rides on those. All right, let's take a look at these questions. See what we got. Issues with the sound. I hope that's not me. T-Row up 50%. Is it too early to sell or best to expect more downside? Oof. If you think the market's going to keep going lower, then it's likely that T-Row is going to go down with it and get dragged down with it. If you're in Chaikin Analytics, I would look and see what the overbought, oversold line looks like. If it's not curling up yet, if it's still pointing lower, I tend to stay in and try to ride it. But up 50%, that's pretty good. Let's take a look. Down 6% today. Whew. That's a good move right there. Took off half a T-Row for 100. Yeah, depending on how you structure your options. So this is options are so interesting. Yeah, one person takes an options position the way that they like to manage their risk reward time horizons, and it's up 50. Another one does something clearly more aggressive, it's up 100. I always, whenever I get a double up at 100 on my options, I always sell half, so I can appreciate what you did with that. You should also have, along those lines, you should have set areas to go. In terms of T-Row going lower, if it breaks this, what looks like support along here, I would expect it to test these lows. So wherever that is on there, that's a, should have known that wasn't going to do it for me. Yeah, we're way below that. This bottom here is somewhere around 99 and a quarter. And if you break that, you're probably going a little bit lower, a couple dollars lower than that. But that's another maybe 2-3%. I think you might be able to squeeze out of it, especially if the week keeps going down. If we keep having down moves on this week, that wouldn't surprise me at all. Oil was down hard, so you got a better put spread for November. with a break even of 129.30 on EOG. EOG is a bear play. I would say that I would look for bearish plays that are below falling long-term trend lines. That's the first thing that jumps out at me. This is moving with oil. So if your view is that oil is likely to fall, then this will come down with it. And if that's your view that's going to continue its move, then that makes sense. Overbought or close to overbought, it's the right time. So I can't argue with that. But I look for things that are below falling trend lines personally. Try and stack the odds in my favor. This is also one of the stronger industries. I think you could probably find, which may be hard to get right now because they're probably oversold and down a bunch. Thinking like SLB and stocks like that, which are similar. But you can always plug this into Discovery. So Noble, COG, some interesting ideas in here that might be similar, that may not, that may have a better look to them on their chart. I don't know what the options look like on this if you're looking for options though. But yeah, this one looks like it may be starting to roll over. Also, still pointing up long-term trend line. So again, I try to stack as many of the odds along the right edge as I can. Is DBZ an ideal typical bearish pick? I think it is an early turnaround, and I think that Dan's looking at the money flow and seeing that it's bouncing around still up near in a range on negative money flow, and if it breaks the range, it goes pretty low. The relative strength is still slightly positive. I typically look for things that are slightly negative or worse, but it is. It's also above what looks like a rising long-term trend line. So, but what he's looking at is this massive amount of negative money flow coming out on a fail to hit the previous high, and basically been in this range for a while now. So, he's looking for a break of that. And if you break that, you have good distance to run. So he might also like the risk reward on it, which my approach takes into account if it's really good risk reward, I'm willing to give a little on some of the indicators. Dan may be doing the same thing here. Shake Shack. Oops. Yeah, so Shake Shack, this is, the trend line's flattened and it's been trading mostly below it. It's right up against it now. You can also see the amount of negative money flow here. Even, again, I'll reference these. One of the things we like to look for are when you get pops, nice pops in price, and you look down and money flow can't make a positive reading on that, it stays negative, or in the same time period gets worse, typically those divergences have lower prices to follow. Just like when you have a move lower and you look down, and in that move lower, money flow goes positive, typically that's accumulation happening on the drop, which is the opposite of distribution happening on the rise, which is what this looks like. You did a bear screen about an hour and a half ago and came up with 25 very bearish stocks. All of them are oversold. When do I buy? So if you're buying, you mean options. And I do it when they're overbought or closer to it. I don't chase a lot of this. I'm not looking at right now adding to my bears. What I'm doing is I'm letting the bears I think that can run at the moment that I already have, and then hopefully converting those profits into buying the dip, because I'm generally of the view that the market's going to end higher rather than lower over the next 6 months. So that's what I'm looking at. But if you think that there's a lot more downside, or you're willing to play a shorter term move, so let's say the next week or two on a move down to 2,800 in the SPY, that if you have that sort of approach, which I don't, and there's nothing wrong, that doesn't mean I think it's a bad approach. I just don't do it. Some people like chocolate ice cream, some people like mint chocolate chip. That's what I'm trying to say here. But if you happen to be someone who thinks that this is going to go down to 2,800, and we've got another, let's see where the SPY closed today. But if you think we have some more move lower in the SPY, oh well, look at that. We're below 2,800 in the SPY. All today. That's fun. This really accelerated into the close. Shoo. Well, if you think we're going to make the next test down, which is the long-term trend line, or possibly even lower, maybe 270, then I would look for the ones that are oversold but not pointing up yet, that aren't curling up. Or try to find the ones, all of them are oversold. Maybe go look for the ones that aren't very bearish. Go find the bearish ones. See if there's a bearish one that's not oversold yet. If a lot of them are oversold, it suggests that maybe this move is not as much farther to go than there may be. But again, I've watched these things stay oversold or overbought. I've taken some bearish trades and they've stayed overbought against me longer than I thought something could stay overbought. So, but I try to get them when they're overbought. Yes, Dow is down 831, and Dan is at a more important meeting. So think about how important that is. Dan is a star. They need him places. What I would do is I would tune in tomorrow morning to his Stock Charts TV segment, 9:15 a.m. Stock Charts TV. Go to stockcharts.com. They have a little tab that says TV. Tech ETFs, so like the Qs. Yeah, the Qs are not good. I don't think I can look at ETFs in this. You can see my alerts. Nothing in my holdings though. All right. Yeah, Qs did terribly. I'm long Q calls, unfortunately. But that was not good. And it looks like Qs sort of on a relative basis are The Qs are back to their early year peak when we had the first major sell-off this year. That's where the Qs are back to. They're back to the price point at that peak. The SPY is below that. So even on a relative basis, it seems like the Qs are still sort of outperforming. Thanks for the SLB idea. All right, you're welcome. I see May 26th. Bird in hand is fine with me. Yes, I agree. I agree. I got lucky and caught the pop in a stock that announced a merger, Hortonworks, which is another Dan Russo special right there. And I did not get out of all of it on the day it first popped. I took half, and I probably should have all. I got greedy, and I didn't make as much the next day. T-Row is approaching oversold, but not yet there. You may be able to let it go a little longer. So, and thanks for the T-Row pick. You're welcome. Listen, they're not all winners. What do I think about an SLB debit play right now? Currently, look at that. See, this is again pick out another divergence. Move higher, look down. Even from the depth of money flow where it was at the bottom there, as this moved up, that went lower. Near the overbought trend line there, the long-term trend line there, it looks kind of good. I would play it probably down to the previous low, if not nominal new low. Down day today, this wasn't updated, so it's at 60. Oh, it's already down there. It made all that whole movement in a day. That's rough. Still might, if it's overbought, I would play a measured move lower, maybe. See if you can get it down to 55. If it's closer to overbought than oversold, which by the look of this chart, it probably is. I don't have Chaikin Analytics up at the moment. I should get them to give me a separate. All right. Sorry, thinking aloud. We'll write that down. SLB debit play looks interesting. Oh, it came off the best bear ideas list. Or I missed it. Oh, looks like it came off. Halliburton's still on there, though. All right. The low, by the way, for Halliburton for the year, for the past few years, is down near 59 and a quarter, which is just made recently. So it wouldn't shock me if we just made a new one. Any thoughts on a November 16, 300, 310 bear call credit spread on DPZ? So that's playing the other side of the put spread. The debit put spread would be the bear call spread, which is where you're selling a call spread. Let's go back to DPZ again. And then the very next question is commenting on buying puts or put spreads when the market is dropping fast and IVs are high. So I'm going to tether these two questions together. I encourage people to sell options when IVs are high and to buy, so take credit style trades when IVs are high and debit style trades when IVs are low. I looked at a couple of call ideas today. And I didn't like the IVs on them. I'd rather wait for the stock to bounce a little bit and the IVs to drop a lot, and then take a swing at it. So when IVs are high, I encourage people to sell credit spreads. When you have a day that's down 3% like this, and if we open up lower, you're probably going to have pretty high IVs on Domino's. The Sorry, looking up some data. The IV percentile, according to Thinkorswim, is 66% right now, which means that if you look at Domino's IV over the course of the whole year, it ranges from about 21 to 51. And right now, it's in the upper third of it, which to me sounds like a good time to sell credits, just to sell credits, double negative, to take credit trades. And when IVs are low, that would be the time to buy the debit spreads, is how I would go about it. So the debit spread from this morning, probably the IV was probably a lot lower this morning, honestly, than it is now. And that trade may have looked a lot more attractive at 9:45 a.m. than it did at 3:45 p.m. So I think a 310 3 by 310 bear call spread on Domino's is pretty good. I encourage people to do it for short durations, not to go out terribly far. The October monthlies are 9 days away. The 3 by 310 looks like it gets you spreads are kind of wide on this. 2 minus 95, but $1 maybe on that, which is pretty good. If you can take in $1 on $10, that's 10% for 9 days, 8 days. So all right, no worry. Is it too late to play Domino's as a bear spread? I think the way that you potentially play them, no, because you tend to mitigate some of the IV by the way you structure your in the money spreads. So it may not be as bad. In fact, for you, depending on, and this gets a little bit in the weeds, depending on the IV skew, it may actually benefit you because your one leg typically is very in the money. That's a very specific answer there. It still may not be too late just for more aggressive traders on Domino's. Maybe this is something I'll cover on my option idea session tomorrow. But if we just look at where the market closed on this idea versus where Dan picked it out, this was a put spread where we are buying the 290 and selling the 260 for November. And at this point, at least where it closed today, well, the 290 put is now trading for I think $20. The 260 is trading for high 680. So $21. 21 minus 680 is $15 on a 30 wide spread. That's 1-to-1. and I would do it. So if I were going to do this now, what I would do is I would just drop the spread a little bit. And I'll talk more about that tomorrow, but just in short, I wouldn't take the 290, 260, maybe you take the 280, 260 at this point. So use the same target, but you tighten the spread up. In this case, right now, the 280s are trading, or last, well, the last bid ask spread, if you go by the midpoint, was around 15 bucks. And again, you're looking at about 680 for the 260 right now. 15 minus 6 gives you 9, costs you 9 for $20 move. That's back to a 2-to-1. That's back to risk $1 to make $2, which makes the risk reward a lot more attractive again. So this particular structure may not be. In fact, had you taken this, you'd be looking pretty right now. Very, very pretty. Break even's at 279 and we closed under 275. There is not an easy way to export the Mastering the Bears list in CA. That's a good idea, though. In general, just an idea, so I'll pass that along. CHH thoughts. There's a question here about shorting a stock outright rather than a viable options play. And I don't short stocks outright. What I have 2 accounts I play in. One of them I don't do it. One of them's an IRA. I can't do it. So I'll give you my answer on the other side of that, which is, do I ever buy the shares when I don't think there's a good call options market available? And that is, the answer is yes. So if I were interested in outright shorts and doing that in my non-IRA account, I would treat it the exact way that I treat buying the shares. But I want to be honest with you, I don't actually outright short shares. So if I don't see an options market available to me, I just shrug and go, well, this is not a play for me. Oh, we're on it. Wish this thing would slide away. That's another idea we're going to plug in there. All right. Ooh. So this is bearish stock. It is been in this pretty big range all year. And currently sitting at 75. So if you think it's going to break that range, then we would do a couple ways of projecting it. One, you could do what's called a measured move, which is we look at the distance of the range, and then we just add that. And distance of the range was 10, we'd go another 10, down to 65. And use that as a target. Now, typically that's a target over a similar time frame. This is quite a long time frame here. This is basically all of the year. You might want to look at half that time frame or something like that. The other way to do it is to just use some form of technical analysis, pattern gathering, or support resistance that would give you a sense of where you think it could go. If you thought you could get back to the yearly lows back here, then yeah, this is a good play, especially if you're a breakdown trader, someone that likes to play the breakdowns of ranges. He's not with his wedding planner. We're very happy for him. MCHP. I missed it. Sorry. Oh boy. Yeah, this really fell off, and most of this move did not happen today. Uh, th- Prior to today, we went down 30% in this. Yeek. Yikes. I generally wait for bounces on these things rather than tend to chase them. Semiconductors have just gotten hit hard. So uh, a lot of the big Dan commented on this, I think last week actually, or might have been on Monday's open forum, that some of the really high PE. Now this isn't even one of them. This is a PE of 12. Oof. The really high flying PE ones are getting just destroyed, which is a shame because I own some of those. I think like CRM, Salesforce, and it was down like 6% today. And when I checked it last, it was high fives. So a lot of these are getting hit pretty hard. And then I was talking with a colleague about some of the lower PE ones as well. We looked at AMAT and everybody's favorite. How can the PE be this low and go lower Micron? Which I get a lot of questions about. Do you think Micron's a good buy based on this PE? I told people at 5, the argument against that was if it goes down 1 to 4, that's a 20% loss. It's at like 3.5 now, but if it goes down to 3, that's a 14% loss. I don't know. I don't like to use PE as a metric on its own. I don't like to use PE in general. So I would wait for a bounce on these. And the high flyer ones are just getting annihilated. These aren't even high multiple stocks, and they're getting hit hard. The PE on this is 8 as semiconductor, but the high multiple ones, this outperformed the market today. Think about that. Down 3.6. Q's down 4. If you look at the SPY, it underperformed it slightly. But bear spread 282.90 is on DPZ again. All right. Anyway, I'd wait for a bounce in some of these ones that are just falling off a cliff, like MCHP. Put spread. Break even at 284. So that's above you, which is good. That's 10 higher. The way that you trade, that sounds like a good trade, especially at if your break even's at 284. It's about $4. $6 it's costing you. So taking 4 on that. I think that's good for the way that you go about it. I think it's likely to stay below that. Back to T row. Should probably just look for all the questions on DPZ and all the questions from T row at the same time. But I just go through these in the order in which I see them. And I see 5 or 6 at a time, so sometimes I I skipped down one or two before I go back to the top. Sorry about that. Back to T row. Mentioned that he would sometimes roll the short leg down. How could this be done in T row? To roll the short leg down, if you're selling, what you would do is, let's say you sold the 100 for October. You would then buy that back and sell the 95. That's a defensive positioning, though. That's a way to minimize losses because you're worried that it's going to go below 100, and instead of sitting on 100 and letting it go below there, you roll it down so you at least take in credit for the 95s, offsets the loss that you're sitting on the 100s. Potentially increase the gains instead of it having to be capped. Oh, if you think it's going to keep going lower, you can do the same thing with the short leg of the debit vertical. You're going to be taking a loss though on a credit trade. Usually, it's done defensively in order to minimize a loss. You want to do it aggressively as a debit trade on a vertical. Instead of rolling the short leg, I would roll the whole thing, I think, just off the top of my head. So if you were long the 290, 260, I'd be more inclined to roll. We're not at 260 yet. So if you're not at your target yet, then I would leave the short leg and roll the long leg. If you are at the target, so let's say you did a T row, let's say you did a 110, 100, and now you're sitting at 100. Maybe now you roll it down to a 100 by 90, and you're going to take in the difference. You're going to sell the 110 by 100 for a tidy profit, and then use only a portion of that money that you just got in profits to go and buy the next one. The other idea is to just roll the short leg, to keep the long leg and just roll the short leg down. I would be more inclined to just get rid of the short leg altogether and just let the long leg run if you wanted to let it go further. Hope that made sense. All right. Couple questions on IV. Talk about high IV in the queues. Oh, so and where do I find IV? So there are two places that I look for IV, that I check my IV. One is on my Thinkorswim account. If you are under the trade tab and you type in a ticker, at least this is how mine's configured, the option chain comes up. And if you scroll down the option chain, below the option trade, it gives you something that says today's option statistics. It's on the left. On the right, they have their sizzle index, which I don't understand what the sizzle index is. I should probably look into that. There's a put call ratio that it has there, which I like. That's nice. And an IV, and it says current IV percentile. Here. That's what it looks like. So I just go to the little trade tab, and then I type in ticker, and then I scroll down past the option chains. And below that, I have today's option statistics. I should do the drawing tools where it's not freehand. And then you see current IV percentile. And that IV percentile tells me where in this range is the current IV. Right? The implied volatility right now is 41. Where is 41 relative between 21 and 51? So that's what I do. You can go and I have this also, this exact basic same concept is available at Fidelity, and you can go to a place called ivolatility.com. and you can get IV charts where you have to do your own bit of analysis. You'll see where the high and the low is. You have to check where the current IV is, and then you got to do some math. But it's not terribly hard. I can walk you through that if that's how you want to go about it, or how you have to go about it. If you're using other brokers that I'm not familiar with, they may have a similar function. I don't know. You can check with them. For instance, on the Qs, if I do the same basic thing for the Qs, the current IV percentile on the Qs is 69th percentile. All right, so here I can see this for the Qs. Current IV percentile. Here's the range up here from 12 to 35.6, and we are currently sitting on the Qs at 28, which is much closer to 35 than 12. All right, SKX. Skechers. I remember when this company came out. All right. Or at least, maybe I don't remember when it came out. I remember when I first was introduced to this. As a wee lad. Skechers USA. It is below a falling trend line. It is bearish. It's in the consumer discretionary apparel industry, which is weak. Interestingly, on the drop, the money flow has been increasing. This is not ideal. This is not what we want to see. This goes down. This goes up. All right, so it's a bullish divergence there. Price down, money flow up. Everything else about it looks good for a trade. I don't like the money flows coming in on a move lower, but I would put this on a watch list. Maybe the money flow is short covering. It could just be short covering. In that case, I would maybe play the trend lower, and wherever the next stop down is on SKX, for what it's worth, I'll go check different chart here. Whew. Settled right on 25, right just above 25. The around 23.75 to 22.75, 22 and a half is where I think that would get to in the short term. And that's just based on previous price movement. My own opinion of that. Dan is on stockcharts.com TV every morning, 9:15 a.m. Eastern Time. He's the lead-in to the market open. Our chief market strategist is the lead-in on Stock Charts TV to the market open. Between Halliburton and AEM, which one do you think with a better bear candidate? All right, let's look at AEM. I am currently long puts on Halliburton. And I'm also not Donut puts on Agnico Eagle, but another interesting bear name similar to it in I think the same space, Wheaton. So it's a weak industry. It's a weak trend. It's been just knocked down back up to 35, which is where you would think you'd see a little bit of resistance coming in. I think that that's reasonable. Which one's the better bear candidate? One versus the other? Um, just saying the metals are up on a daily today. I would say AEM uh, is the better bear candidate, and that mostly has to do with, well, they're very similar. They both registered just a little bit of green money flow. This bounced closer to its long-term trend line. The other one had a big drop and then it's gone sideways. It's a very tough choice. Very tough choice. I would say edge to the non-oil related one. VIX spiked to 23 at the close today. It rarely stays at this level for more than a day. That is true. I did, as an options guy, that was one of the things that I went and took a look at today was the VIX. I looked at the VIX. I looked at the VIX futures term structure, which is in heavy backwardation. Heavy backwardation. How's that for a phrase? We are sitting at 23. The last time the VIX was at 23 was April 6th. So if you check a chart of SPY, you'd see a sense of where that is. We had an enormous day up in the VIX. We went up about 44% today. That is a huge, huge move. I would expect typically on moves up like that, you get, at least this year, you get a move that's, well, the one at the beginning of the year is much, much higher following a day like today. Other moves with days like today's had a little bit of digestion happen after them, let's call it. Sideways a little bit. Here, I can show you a chart of this too. Ooh, that's big. There, let's chart of the VIX. This red line you see down here at the bottom that goes across the chart at the bottom is 12. As you can see, is typically around the low end most of the time. We closed up here. You can see the size of that candlestick. If you look back, this is the last time we really were there. That's April 4th. And if you look at these big moves up, typically you get a little bit of chop afterwards. I would expect another pretty volatile day tomorrow. and we might move down in terms of volatility, but I don't think we're going to give back this amount. And if it goes against you, that's true, but it usually doesn't sustain this high for very long. Just look at the number of days it took the VIX to go from peak to trough. I mean, this is really, this is down 13%, 14% in the SPY. So let's just put that into context too. That's the sell-off from earlier this year. And even then, 15 days to get back down to here. Another 8, that's 23 to get to there. Now, had you gone short on this up day here, you would have had to buy enough time to make that, to do that. Other instances, that's 17 days. That's like a week. Not very, I mean, these are not, does not take long usually to have the air sucked out of these if it is not a sustained down move. And if the move even happens for another few days, it tends to, again, come back quickly. So I would not tell you to stay. I would use VIX. You use VIX options. You could outshort the VIX. There are different ways you can do that. VIX options are going to be a very fixed cost way to do it. You could try to go with in the money VIX options. I would use VIX options are priced by different months. The front month is going to be the most volatile. You may have to roll it. You want to see how much time left to the front month. You may want to think about doing next month, which are going to be lower in terms of the pricing. So the VIX is not the VIX futures. Another way to do it is to go maybe deep in the money on a VIX ETF. If you knew the futures, that's probably the best pure play. And then I would, depending on how quick you think this is going to snap back. If you think it's going to happen quickly, then front month. If not, then I would go second month on the VIX futures for the options or the outright shorts. So there's a question about quick, easy site to get the IV info deltas. I use my brokers for that, my brokerage accounts for all those options data stuff. I like bringing things over to the C-suite, folks. Thank you. All right, I'll make a note of it. Depending on how long, we're quote after hours now, but I can hear some of the C-suite folks behind me. Seem like they're having a good time, which is good. FNKO. I don't think I've ever heard of this company. This looks like a new company, and I say that because we don't have power gauge data for it yet. The long-term trend line is not very long-term. In fact, it doesn't even fill the back end of the chart. So somewhere around here is when it IPO'd. I don't have enough data really to make this is outside of my data. So this is outside of my normal analysis process. I'll be honest with you about that. If you think it's going to break down, so if you think that what's happening here is going to break down, then I would look for the next one to, this cluster of trading would be my next target, and then maybe down at this cluster of trading would be my next target. And that's how I would try to play that. But that's a little bit on your own. We don't have data to except to say we're not even very bearish. We don't even have enough financial metrics. This is not, we don't have enough. I know we have some metrics here, but we don't have enough to have a power bar rating for it. So you've been in the MCHP. Oh, great. Congrats on the MCHP puts. when they're very deep in the money. So here's the thing: once they're very deep in the money, you're close to maxed um, on the on the trade, and what you really have left is you're going to really, it's mostly going to be time decay, because once you get deep in the money, the long leg has much less extrinsic value than the short leg does at that point, where that was not necessarily the case when you entered the trade. And you didn't really take a directional trade for time decay reasons. Time decay reasons more are credit trade based. So what I encourage people to do is, you've got significant profits in that. And if you want to continue taking the downside on that, then just roll the whole thing down and book your profits, and go from there. And that's how I would play that. You're going to make the difference in the deltas at this point. That's probably not much. All right. Is it too late to jump into DPZ? I think it depends on your time horizon on that. And oh, late breaking news, everybody. Mark is doing a special webinar, 10 a.m. tomorrow. We will be
members only, just talking about what's going on in the market.
All right. We'll be sending out an email to everybody. So check your email for members, Chaikin Analytics members. Check your email for a special webinar with Mark at 10 a.m. tomorrow.
And Mastering the Bear clients.
And Mastering the Bear clients too. Sorry, got a tap on the shoulder from one of those C-suite folks. I got to go hand that idea over that you sent in earlier. I'll mention that again before we wrap up. Let's see how many of these questions I can knock off before we wrap up for the day. I have maybe another 8 minutes here. All right. Other than Thinkorswim, where can I find the IV range? iVolatility.com is where I would go for that. iVolatility.com. You can get your own free account, join free. And so look at this. Now I'm promoting these guys. Yeah. All right. We're not going to do that, but what they're going to give you is charts that look like these yellow blue charts here. And what you'll see on these yellow blue squiggly line charts, this is how I use this, is you're getting the IV range. So I can just say that the IV in the stock at the bottom, I know the IV range is from the bottom of that yellow line, which is about here, to about the top of the yellow line. So that's the IV range. And then I go check the current IV for the trade I'm taking. And if it's somewhere closer to here, I like debit trades. If it's somewhere closer to here, I like credit trades. Number of credit spreads that expire in December, and they're down. Would seem to be small numbers. You can think about rolling them so that you can hedge that a little bit. You can December is a long enough time frame. You could just hold them and see and ride out the downturn. That I'm long some Q's calls, and at the moment that's what I'm doing. Is I'm now, if they hit a certain number, I'm not there yet, but we're getting close. For some of them, at least part of the position, I'm gonna have to cut, but just from a risk tolerance. But and they're at the end of the year. I'm hoping to be able to ride them out and pull out a better profit. So that's my thoughts. I feel like I have time. So I have some. There's a question about mental stops, and I have some actual stop losses plugged in, but only on the liquid stocks. So like Halliburton trades at fairly tight bid-ask spreads. It was like 3 cents when I entered the trade. That is something I'm willing to put a stop order in, because stop orders trigger at market. If you're using a stop market order where you specify stop market and you put in a price, it triggers a market order at that price. And when you have a market order, it fills, if you're if you bought it, it fills on the bid when you sell it. And the bid's the lower one, so it sells at the lower one. But if it's only a couple pennies, it's not a big deal. It's a big deal if the spread is 80 by 20, 80 by 120, and then it drops down to 50 by 90, and you get taken out because the stop market order triggered at 50 because you entered at $1 when the midpoint is like 65 there. So mental stops when there are wider spreads and actual stops when there are tighter spreads also depends. There are some option trades I take that are just small enough in position sizing that I only exit when the indicators change or I hit profit targets because I'm willing to give up the whole of it, which I don't like to do and I don't do very often, but there's sometimes I feel that it's just, if they're volatile, want to be able to give it some time to run, maybe that sort of thing. So especially on some of my, anyway, position size to manage risk sometimes. That way I don't have to use stops quite as much. But usually it's a mental stop, or if it's a tight enough spread, it's a stop, actual stop. SIMO. Silicon Motion. It's a neutral stock, so I would encourage you to look toward bearish names. It was outperforming today, interestingly, but it's fallen off hard, and the trend line's rolling over. Industry's weak. I would say look more for bearish stocks. If you think that this is going to break further at 48, geez, it's down. I wouldn't be looking to buy it, that's for sure. Unless it has relative outperformance in the market. Like I looked at buying Visa today. I didn't, but it was one of the things that is on my shopping list. So, but that's a neutral plus. Neutral, was bullish, outperforming the market, was above a rising trend line, more of an Adobe type trade than this, which is neutral, is choppy. The chart of Visa does not look like this. So I wouldn't be looking to buy this and shorting it. That's it. I'm looking to buy in this environment. I'm looking for things that look like this to buy on weakness. Chasing it lower, I don't know if I would looked at a bear trade with it. I don't know if that's what I would be chasing lower at this point. Depends on if you think he can get, where do you think he can go? Depending on where you think he can get to. Oof. It's at 48. The lows of the year are down near 42 and a half. So if you think you get down there, that's another $6. That's reasonable. Its range today was inside of yesterday's. It held the earnings low from the past earnings, but not very convincingly. If you only think it's going to get to 46, you're chasing $2. If you're using outright shorts, then $2 on 48 outright shorting it, that's going to give you another about 5%. That's not bad if you're risking 3%, 2% to do that. I think 2% is easily within a 1 day range of this, though. So 5% is within just a couple days. If you're chasing momentum in a break of the lows, I think that's reasonable. If that's a style. If you're using options, it's good. I mean, that's a very tight spread, which might make it worthwhile. But probably not. But no, just a thought. 46 is not that much farther at this point, but it's plummeting. It's had a couple of days. This is just 1 day in a series of 3 that are down by the looks of it that amount, and in the last 5, 4 of them have looked like that, and the 5th one was a kind of a sideways squiggly day before the next big move lower. So yeah. The VIX IV is huge. Yes, it's hard to trade the VIX. It's volatility on the VIX is volatile. There's something for that, the VVIX, and you can even trade the volatility on the volatility of the VIX index, which is the volatility of the S&P 500. I would say deep in the money options. It's a way that way it lowers your extrinsic value. It makes the break-even number a lot closer to where you are currently. It slows the win and loss down, which on something like the VIX, probably a good idea because it moves a lot. So I'd suggest if you want to play, if you think the VIX bubble is going to pop because it's up 40% at 23 and you don't think there's much more upside and you think it could fall back to 16, that's I would just buy a deep in the money put to play it. That's how I would play it. Or outright short the future, sell the futures contracts. Or outright short the ETFs. But just, we'll leave it at this. Oh, it's not going to say it's an ETF. The common ETFs that generally track the VIX, like the VXX, which is the inverse, the VXX was up 16.5% today on a day where the VIX was down 40. Sorry, up 40. So, pardon me. Clearly, it's not tracking it percent for percent. And if you're looking to play it that way, which is a more volatile way, but if you're looking to play it that way, futures market is probably the way to go. And that's leverage on leverage, options on futures. All right. That has been the Mastering the Bear session for today. Thank you all for joining me. Before you leave, please check your emails. Mark is doing a special webinar tomorrow, 10 a.m. for all Mastering the Bear members and Chaikin Analytics members. Please check your email for a link to join. That's, again, 10 a.m. Eastern Time tomorrow. Copy of this webinar will be made available to those of you who want it upon request. Please email us at info@chaikinanalytics.com. Happy bearish trading, everybody. See you soon.